All right, good morning, everybody. We got a red to green setting up on a lot of names today. It's going to be a good thing. But as usual, we want to start with the market watch. CPI on the deck. You know, there's been a lot of angst in the market about inflation. And so everything that's been coming out has been viewed with the skew or the tint on the lens of how is this, helping or hurting in the inflation discussion, and or you know how is the inflation doing, meaning the number that would come out would tell us that it's getting better or it's getting worse. So it's always been those three metrics. Is this a number that is going to be expecting to change the situation, or is this a number that is just telling us how the situation is? It's a distinction that makes understanding economics a little bit easier. As a trader, the more you understand the economics behind all of this, the better trader you'll be, right? Most of us don't have economics degrees, however, me included. The good thing is if you want to figure out more about these, if you want to understand more about them, right, a little bit at a time, these descriptions here come from a company called EconoDay. Thinkorswim reaches out to their website and gets the data and puts this description in here. And the description is pretty good. I mean, it's not bad. It gives you the point of view from a bond trader's perspective, or from a more of a stock and options perspective. The go-to would be going to their website. They have a paid version I've never used, but they have a free version too. And you can access this material and you can learn more about, the background in these economics. We can all become, basement economists with a little bit of effort. So on deck today, it's CPI. It's a real big deal. There's some economic news in the overnight hours from around the world that was a rock in the market really early in the morning. We've been kind of rallying up out of it since then. Notice we're on the March contracts here on the ES. Thinkorswim is a platform that is what they do. They say a continuous contract, right? So unless you specifically tell Thinkorswim which contract you want, it will automatically manage the contract for you. One thing that I did when I was a newer futures trader is I watched for Thinkorswim to roll forward. On the day that I seen Thinkorswim had rolled forward, then I would roll forward in my own broker. Trade-of-8 and Ninja and those kind of brokers don't generally show continuous contracting. You have to go in and manually make it a continuous contract. On Trade-of-8, what you would type in is the @ symbol. So if I wanted to look at a continuous ES contract, say, on a daily chart 3 years back, use the @ symbol. It's also a nice thing to do if you want to look at charts and you want to make sure that somebody can't accidentally hit the button and fill you into a trade, right? Because you can't trade the continuous contract in Trade-of-8. So we had a little bit of news start to turn us around last night. We had this little micro double bottom. Things started to pick up. I had a little fun trading last night in here, actually using a MACD crossover and a 10-20 moving average. It was had a little bit of fun. Just kind of was in the office anyways. I may as well do something. So we came up off of those lows. We did manage to have a very tight initial balance. And now we're expanding outside of that initial balance. The goal for today, we have an ADR of 1.5%, and we're only up a little more than a quarter. So we have plenty of room to run. The thing is, we don't have plenty of time left to run, right? We've already burned 12 hours of the day. So while this thing has an average daily range of 1.5%, we're running out of time. If we're going to see an amazing move, this market's going to need to get lit up, right? And it's going to come from the CPI data. Now, coming back into Market Watch for a minute, 8:30, 10, 1, and 2. Now, that rig count at 1 o'clock, I have no expectations that thing's really going to do it, right? Not really expecting anything. Surveys, most of the time surveys are just kind of, whatever, and nobody really looks at them. But there are times where that's not exactly true. So, with the way the market has been and just the really strange stuff that we've been seeing, be careful at 10 o'clock. We normally wouldn't think these surveys are going to do anything, but man, just if you're not in a trade, how about just hang back, let 10 o'clock come and go, and if nothing happens, then nothing happens. The big one though is going to be at 8:30. Now the dollar opens at 8, the bonds open at 8:20, so at 8:30 we're going to get some information that is very likely to light this market up one way or the other. A positive market with positive numbers means we're going to be breaking through this Globex high, and then we will deal with the RTH yesterday's high, and then the Globex high of yesterday. And again, if you think that I'm reaching into unrealistic territory, that's less than 0.75%. Add the 0.25% we have already, and that's still below the ADR, the average daily range ADR. So that would put us into the highs. Considering those are so close, we'll just drag that back. When you're drawing lines, instead of imagining a very sharp pencil, try to imagine that you're drawing lines with a very dull crayon. You want big, fat lines. Think of them more of them as a zone or an area, and not a specific point to be leaned on like a handrail. There's a story behind that. Someday we'll get to that. So if it doesn't work to the upside, we go to the downside. We will first come back inside the initial balance, resolve this micro double bottom, and begin the move back down, which very likely is going to start with a break of 46.40. We should move through this area relatively quickly once we break that low, because that low really is this high. We get underneath that, we'll move through this area very, very fast. Very fast. If we get through this low, we'll move through the next area very fast. There's nothing there, right? There's no structure in this area. If I was to turn on a volume profile, you would find it very shallow right there. And shallow volume profiles are areas where price can move very fast. So a break to the downside, hitting branches on the way down. There's the ADR, and we wouldn't even be out of line. So you're looking at a cog line, 46.11. That would be my downside target. Now, we didn't mention it. Doesn't do any good to type it there. Let's try over here. The weekly expected move. You can see that the lower edge of the weekly expected move is a long ways down. There is a midpoint for the week that is not really shown because I keep the color dark to match the background. I want the line. I just don't really want the line to show up, but there is a line at 45.34. It's unlikely that we would hit that line today without an exaggerated move in the market. Believe me, it would not be subtle if we were to go that far today. That would be all the way down here. So this is a floor pivot. And the reason I'm turning on the floor pivot is if we change the language about what a floor pivot is, this purple line, what does it represent? It's yesterday's average price. Because the math behind it is high-low close divided by 3. You could use open high-low close, but then you have to divide by 4, right? Because you're measuring 4 things, divide by 4, measure 3 things, divide by 3. So this purple line is yesterday's average price. Right now, we're just coming in to yesterday's average price. So if you're feeling like, we've made some moves this morning, you can realize we haven't gone anywhere yet. We're basically sitting at yesterday's average. So if an institution wanted to trade today or wanted to buy today, they could look at it as, yeah, I'm getting it for the same price that I could have got it yesterday. There's what we call a missed daily pivot. It's worth going and learning about MDPs. And the reason I turned this indicator on wasn't to look at a daily. It was to look at the weekly. To be able to ask the question, where's the weekly pivot? That's all we wanted to be able to ask. Where is it? It's below us. We're not going to hit it. We know now that we're not going to hit it. No problem. We don't need it now. We can just turn it off. You wouldn't know unless you turned it on. All right, Nasdaq, same thing. A little bit of news brought us up off of those lows. We had a very tight initial balance, all things considered. Notice we really didn't have a significant move in the kill zone on either one of those markets either. So positive numbers in the CPI. We will look to reclaim the Globex high. We'll deal with this pivot point back yonder here. Basically, the open is what we're aiming for here. I shot it all the way across looking to see where it would line up back here, but it's the open that we want to mark. May not need it though. You get too many lines drawn and it just becomes a cluster. 16,400 would be the upside target, or right around in there, since it does basically encompass yesterday's highest RTH value. It's close enough in scope that you could decide to just mark the zone from yesterday's Globex to yesterday's RTH and then just throw the box across the screen. That area would be our critical reversal area. I don't think we're out of line. It's 2.5% move. We've got a 1.92 ADR. So yeah, it's a little much, especially since 12 hours have already passed. Very likely we wouldn't make that without a lot of fireworks. It would look very similar to this, right? You see how it moved a lot in the pre-market and then it moved even more. This was a very unique day. We don't get a lot of these. And of course, when we get them, nobody trusts it. Well, we didn't get all of the pre-market move. We could still get this part of the move if the numbers come out in a way that's positive. But what about if they're negative? So that'll put us back in the IB box. We will then deal with yesterday's low. This is a very shallow area in the profile. And the danger is if we happen to break this low, we could move through this zone very fast. So, going from 16,100 to 15,9, a 200-point move would be like dropping a brick in water. Nothing here to slow it down. So, kind of keep in mind, if we break 16.1, it's game on to the downside. There's no parachute to slow it down. For the weekly expected move, you can see it's over our head at the moment. Just make it something that stands out so when we come back. All right, so that's the weekly expected move, and you can see we're kind of bumping our head against it. We were outside of the box. Now we're back inside the box. It's very likely that we're going to close inside the box. We'll know more in about 45 minutes. It is worth noting that the SPX is a much, much more accurate product when it comes to evaluating the overall S&P marketplace, and especially actions and reactions around the weekly expected move. Right? This thing pins to one of these levels at the end of the week more than is statistically supposed to happen. Right? More than that. They call it statistically significant how frequent this thing closes on one of these lines at the end of the week, pinning because of the amount of money traded in there in strangles. There was a little bit of concern about the Dow last night, but it resolved this. So this is a perfect example of a gap close and the reaction after closing that gap, right? If you're ever looking for a mean reversion trade play, just a couple of points, this would be a good one to study. We gapped down, had the IB, set that range, broke out Busby, tagged and closed the gap. I mean, it's like a whole package here worth studying. I'm not interested in trading the Dow. It's the setup that we're looking at in here. What a perfect example of opportunity. So you can see the bonds really haven't done much last night. We're still inside of yesterday's range. And the dollar, well, it was. The dollar is outside the boundaries. It left yesterday's range. It's been on a pretty good move in the last 2 days. All right. Starting with Wednesday at the close, running through Globex into Thursday, and then running last night and getting out of the box. We really want to keep our eyes on this, kind of asking, where is it going? Who's buying it? Does it look like the VIX? And that's a real important question to answer, right? Because when it comes to the dollar, it's the why behind it that really, really matters. Just seeing, quote, a strong dollar or a weak dollar, that doesn't tell us anything. We need to know, is it reflecting global risk? Are they buying into the dollar because they're scared and they're looking for a haven? Or are they buying into the dollar to have access to our market? So when the dollar and the VIX are tightly correlated, then we look at it as an extension of VIX for a global market. And you can see how the other day they were in sync, right? When that changes, it just tells us that there's now a disconnect between what we see in the dollar and what we see in the VIX. And if you're an economist, you understand exactly what's moving the dollar at all times because you'll know about resources the rest of us just don't know about. For me, I usually try to find a place who has that resources. Like TD Ameritrade will talk about the dollar on their Think ticker tape publication, or Bloomberg will have an article about the dollar, or will discuss the dollar during one of their TV episodes. So just any kind of perspective from some sort of trusted source on what's moving the dollar and why it's moving goes a long ways. There was an auction yesterday on the 30-year, and you would have never have known it. I even had someone reach out and ask, "Hey, when is this supposed to move the market? If it was gonna, it woulda." So when we didn't see anything happen, that just means there's not going to be anything happen. And you never know. We want to be prepared for an event, and if no event happens, then no event happens. And that's what happened yesterday. The 30-year slipped right by and just ho-hum, nothing and nothing. Okay, that's so be it. All right, we're looking at the S&P. Got it adjusted for pre-market change. I am using a filter to get the names down. I don't need 500 names. I want it closer to 100 names. Adjust the color scheme just so that it is going to not be gray if it's up, even like 0.25%. We got a lot of green, but boy, we got a lot of red too. Healthcare is kind of a mixed bag right now. Across the board, every single sector and every single industry seems to have some big names in both directions. Oracle had really great earnings, by the way, which is why it's up 11.25. Costco has earnings, but I haven't gone over to look at it yet. When you're looking at these names, you really want to be thinking about what they represent, what industry, what sector. So here we got the Nasdaq 100 pre-market change adjusted for color. Again, it stands out. We're really mixed this morning. It's all coming down to the CPI numbers. No amount of technical analysis on the charts can assist us at this point when the numbers are going to move this market. And that's just the end of it. Asking how many names are up this morning in the pre-market, looking at the S&P, 34 names are up 25%. That's not enough for me. I always want to go more than that, at least 0.5%, 16 names. Sectors that really stand out of those 16 names: electronic technology, Raytheon, NVIDIA, Broadcom, which Broadcom, that's probably a carryover from its earnings because they knocked it out of the ballpark. For the Nasdaq, no, I don't want to say that. Shush. For the Nasdaq, 14 names are up 1/4, or at least 0.5%. Electronic technology leading the way in Nasdaq as well. Chip names: microchip technology, NVIDIA, AMD. So, they're not up by much. Sad to say that, when we look at it and we think, oh, 1%, yeah, that's not up very much. 1%, dang. Companies that have weekly options. TradingView won't let me use this screener on my own watch list. It's one of my biggest pet peeves with TradingView. Such a simple thing. Let me scan my own freaking watch list. Oh no. No, they won't let you do that. So I can't put this list into this thing and sort it. That's all right. We can kind of get an idea of what's going on here. Weekly options companies. There's not a great amount of names up this morning that 0.5% line in the sand that we use. So everybody's just waiting with bated breath for these numbers to trade the reaction. I'm really thinking you're not going to want to try to run the sectors today. You would most likely be better off using your screeners and just hunting down those individual names that are going to offer opportunity. It's 0 day today. So, SPX, IndieX, RUT, those are on the table, but also really big names, 0 day in Amazon, 0 day in Google. Those make for really good trades, and they do have enough strikes that if you want to be, one of those out of the money options traders, that you could go in and build some pretty wide spreads on something like Google or Amazon in the middle of the day, or maybe even the later half of the day, just with an understanding that it'd be unlikely for you to get whacked at that point. Now, we never want to say, that you're safe, right? Because there's no such thing. You can get hit. But take for an example something like Google has an ADR of 1.8%. If I was to measure a 2% move, and Google opens and runs 1.5%, then I could put on that 2% move credit spread, right? Because Google exhausted itself. It made that 1.5, 1.75% move, stopped at lunch, kind of paused, and isn't really doing anything anymore. Perfect. That would be the time to finish the afternoon with an out of the money credit spread. You're not talking about a significant amount of money, couple hundred, maybe a couple thousand, depending on the size of the position that you put on, but it would be paid by the end of the day. And while we say, it's a low risk, when it comes to these out of the money options, just understand the two words that I'm trying to use here: risk, as in how many dollars do we have at risk, and then risk, as in, damn, that's some risky stuff. Bungee jumping, e-games, not taking out the trash, that's risky stuff. So putting on an out of the money credit spread where you are risking 5 to make 1, that's risky stuff, right? And it has a lot of money at risk. The thing is, this will win more often than it loses. So we call them, quote, low risk trades because of its high degree of win rate. I don't like to call them low risk trades, though, because dang, they hold a lot of monetary risk. Either way, if we have an ADR of 1.8 and I measure out a 2% move, and then Google makes a good, strong 1 and 1.5%, maybe even 1.75% move and stops at lunch, then it would be a trade opportunity to come in at that point and target that 2% area, 30-10. So we go to the call side. Remember 30-10, if Google had already ran a good 1.5%, the 30-10 would be pricing somewhere around in here. Right? So I'm going to build the trade right around in here, but we would be using these strikes, right? Because if you think about it, as Google runs higher, these options would end up in the money. So we would be looking at options that are here, are a lot closer to the money. That's a $20 wide credit spread. And you can see why I say that they're so crazy dangerous. This is $20 wide, which means it has $2,000 total. And if we, are generous and say that we collected $3 in credit, where's the other $1,700 at? Oh, that's your loss if you happen to be wrong. You don't want to risk $1,700 to make $300. Not all the time. We wouldn't want to do it. We wouldn't even want to fill an account up like that, right? Those are just mad, crazy trades. It will win 90+% of the time, but dang, when you're wrong, it hurts. So when you want to go and put one of those on, you want to tie it into a situation where, it's to your advantage, that you're not just blindly putting it on first thing in the morning thinking, oh yeah, Google can't move 2%. Yeah, it can. Let it move through the morning and get that energy burned. And it has energy. It's been sitting here for 3 days, winding up more and more and more energy. It's ready to go. Let it go. Make it smooth through the morning. And in the afternoon, put on a credit spread outside of it, right? Then you get your 0 day. By the way, 0 days work really good first thing in the morning, and you're not stuck in them all day long. You're just looking for the initial move. The first 60 to 90 minutes of market movement will knock your credit spread down about 55 to 60% profit. Close them down. The problem is it's first thing in the morning, right? When the bell rings, you're trying to get in the first 10 minutes. We don't quite have a definition of where the heck the market's going to go for the day in the first 5-10 minutes. Plus, it's hard to get filled. There's a lot of slippage. So it's got goods and bads. Just keep in mind these really big products, Google, Amazon, even Tesla, it's got pricey options, makes for a perfect 0 day product. Let this thing make an exaggerated move on the day. Come in the afternoon, put on your 0 day credit spread. Grab a couple of $100. Yeah, that's what I got for you guys. Be careful, be safe. Everybody have a good weekend.